Welcome to Capital Allocation Lab.
Yes, welcome.
And please make sure to subscribe and like to support more educational episodes.
We really appreciate the support, yeah.
Today, we are opening the dossier on a highly specific, structurally fascinating, and frankly, deeply challenging topic.
Oh, absolutely. Challenging is definitely the right word for it.
Right. So the exact title of our session today is Why Preferred Stocks Disappoint, Episode 14.
And as always, our mandate here is uncompromising.
Fully uncompromising.
Right. It is a strict, unwavering adherence to the primary text. We are here to evaluate the fundamentals of the document exactly as they are presented to us.
Exactly as presented. No outside assumptions.
Precisely. Without bias, without extrapolation, and with a relentless, almost forensic, I would say, focus on what the data actually says.
Right.
We do not deal in hypotheticals when the text is clear, and we certainly do not invent narratives when the text is absent.
Right. And usually, when we talk about fundamental analysis on this deep dives, there is an inherent expectation of precision.
A huge expectation, yeah.
You think of it like engineering or maybe forensic accounting. You pull up a company's 10K, you look at the balance sheet, you examine the cash flow statement, and the numbers are, they're just sitting right there in black and white.
They're tangible.
Exactly. It is a binary reality. The data exists. You might misinterpret the data, or the market might price the data incorrectly, but the baseline numbers, the revenue, the debt load, the outstanding shares, those things are tangible. They are visible.
It is comforting, honestly. We, as analysts and allocators of capital, our metrics to be visible.
Oh, we love it. We need it.
Right. We want them neatly categorized in their respective columns so we can run our discounted cash flow models, assess our margins of safety.
And to calculate our risk-adjusted returns, right?
Exactly. We rely on that fundamental visibility to assess risk and, ultimately, to deploy capital. Our entire intellectual framework is built on the assumption that if we ask the system for the historical data, the system will provide it.
But what happens when that assumption fails?
That is the big question.
Because sometimes you step into the research process, you go to pull that crucial piece of historical financial data, the exact data point your entire investment thesis hinges on, and suddenly that system of precision breaks down entirely.
It just vanishes.
Right. You are not met with a disappointing number. You are met with no number at all.
Just a void.
You are left staring at an anomaly, a blank space where the thesis was supposed to be. And that is exactly the diagnostic reality we're looking at today with this specific document provided for Episode 14.
It is the absolute definition of an analytical void. And, encountering a void requires a very specific and highly developed type of intellectual discipline to confront properly.
It really does. It's not for the faint of heart.
No, it's not. Because when the data vanishes, the amateur panics, or worse, begins to guess.
Oh, guessing is the worst thing you could do.
The professional, however, stops. We have to address the reality of what is actually in front of us rather than inventing the data we wish we had.
Okay, let's unpack this immediately because the mission of this session is to go line by line through the provided text for Episode 14.
Right, line by line.
We are acting as a faithful, rigorous audio representation of the script provided to us. We are looking at the document titled Why Preferred Stocks Disappoint, Episode 14.
Yes.
And I need to lay out the immediate reality of the source text we are confronted with, because it changes everything about how we proceed.
It changes the entire paradigm.
I will read the first half of the primary factual text provided in the dossier. It says, the original generated script file is not available in the current workspace.
Let's pause right there. Let's not move past that too quickly.
Okay, pausing.
Because that single structural sentence completely redefines the parameters of our entire analysis today.
It really does. And frankly, it's incredibly frustrating.
Very much so.
I want to look at this from the perspective of a fundamental investor, because that is the lens through which we view everything on this show.
Right, the fundamental lens.
Imagine an investor conducting deep due diligence. You are looking into a complex legacy corporation. Perhaps you are trying to verify a specific, highly illiquid asset on their books.
A very common scenario.
Right. You request the historical financial data from the management team, or perhaps you're looking for a physical, original stock certificate that proves ownership of a vital subsidiary.
And then what happens?
And the response you get from the corporate archivist or the investor relations team is not a spreadsheet. It is a statement that the historical financial data is missing. The stock certificate is simply lost.
Exactly. The underlying asset, the absolute foundational proof of the investment thesis, cannot be located within the designated parameters.
It's just gone.
It is an information failure at the source.
Now, what does a disciplined investor do in that exact scenario? Let's say you were looking at a bank and you want to verify the quality of their loan book and they tell you the file is missing.
Right.
Do you just guess what the balance sheet said? Do you invent the numbers because you have a strong intuitive feeling about the macroeconomic environment or the company's historical performance?
Absolutely not. To do so is to abandon the premise of fundamental analysis altogether.
It's financial suicide.
It really is. That is the quickest path to a permanent, unrecoverable loss of capital. You cannot build a durable investment thesis on top of a known informational void.
But I have to push back here on behalf of the listener.
Okay, go ahead.
Because a listener tuning in right now is saying, wait a minute. I clicked on a title that says, Why Preferred Stocks Disappoint. I came here for an education on capital structure, dividend yields, and interest rate sensitivity.
Which is a completely fair expectation.
Right. If the file is missing, aren't we just wasting their time? Shouldn't we pivot to general market principles regarding preferred equity? We both know how preferred stocks work.
I understand the frustration, and it is a completely natural reaction. But we must categorically reject that pivot.
Categorically.
Yes. Why? Because the moment we substitute our own generalized knowledge for the specific hard data provided in the dossier, we cross the line from analysts into fabulists.
Fabulous. Wow.
Yes. Our mandate is strict adherence to the text provided. The text provided does not contain a thesis on preferred stocks. It contains a notification of absence.
It's literally just a notification.
Exactly. If we were to start reciting textbook definitions of preferred equities right now to appease the listener, we would be interpolating.
We'd be making things up.
We would be generating a narrative out of thin air to satisfy a desire for content, rather than respecting the truth of the document in front of us.
So you are saying that forcing a general conversation about preferred stocks when the specific text regarding preferred stocks is missing is intellectually dishonest.
It is worse than dishonest. In the context of capital allocation, it is dangerous.
Extremely dangerous.
Investing based on an internally generated narrative rather than the hard facts presented in the actual dossier is exactly how sophisticated investors get wiped out.
Right, because they start believing their own hype.
Exactly. You start believing your own structural assumptions instead of acknowledging the objective reality of the data presented.
And the objective reality today is an abscess?
You must deal with the reality of what is currently in front of you.
If the certificate is lost, it is lost. You can't just draw a new one on a napkin and call it an asset.
Precisely. You have to price in the absence of that information. You have to adjust your risk model to account for the void itself.
Yeah, that makes sense.
And here in episode 14, we are dealing with a literal void of expected data. The absence of the file is not a barrier to our analysis. The absence of the file is the data point we must analyze.
Let's dig into how a market prices that kind of void, because this is a masterclass in information asymmetry.
It truly is.
When a publicly traded company delays its 10K filing, stating that the data is not available yet due to an accounting review, what happens to the stock?
Oh, it plummets.
It completely craters. The market does not give the company the benefit of the doubt. The market assumes that missing data equals terrible data. The void is priced with a massive risk premium.
That is a crucial mechanism of risk management. The market abhorring a vacuum is a defensive reflex.
A survival reflex, really.
Yes. When data is withdrawn or unavailable, the uncertainty spikes. The range of possible outcomes widens dramatically, and the downside risk becomes unquantifiable.
Unquantifiable risk is the worst kind.
Exactly. Therefore, the only logical move for a fundamentals-driven allocator is to step back, require a much wider margin of safety, or exit the position entirely until visibility returns.
Which brings us back to the specific wording of our text. Let's look very closely, forensically, at the language the system used.
Let's do it.
The text says, the original generated script file is not available in the current workspace. Notice the extreme precision of that language.
Very precise.
It does not say the file was never created. It does not say the file was permanently deleted. It says it is not available.
Right.
And that places a very specific geographic or systemic boundary on that unavailability in the current workspace.
That distinction is paramount. It is bounding the problem.
Bounding the problem. How so?
Well, in digital architecture, just as in corporate finance and institutional investing, a workspace is a defined parameter. It is the immediate, accessible environment where active processing and decision-making occur.
It's where the work gets done.
It is your active, cleared data set. By stating that the original file is not available in the current workspace, the text is acknowledging a strict boundary limitation.
It's essentially saying it isn't on the desk in front of us.
Yes. It implies that the original file, the document containing the actual promised mechanics of why preferred stocks disappoint, might theoretically exist somewhere else.
Like on another server.
It might be sitting perfectly intact in a redundant backup server, it might be locked in a cold storage archive, or it might be marooned in a different systemic node that failed to sync.
But none of that helps us right now.
Right. From an operational standpoint, its existence elsewhere is completely irrelevant. It is not here. It is not accessible to us in this moment for this specific analytical session.
I love that you brought up the operational standpoint. It's like a multinational corporation telling its shareholders, we absolutely have the Q3 earnings report for our Asian subsidiary, but it's physically locked in a vault in Singapore.
And we lost the key.
Exactly. The legal team over there lost the key and we can't get it open before the closing bell today. Does the report exist? Philosophically, yes.
But practically, no.
Right. For the practical purposes of an investor trying to make a capital allocation decision in New York right now, it effectively does not exist. You cannot trade on a document locked in a vault you cannot open.
Exactly. And this illustrates the difference between theoretical existence and operational availability.
That's a great way to frame it.
As analysts, we cannot trade on theoretical data. We can only allocate based on operational, available data within our current workspace. The current workspace is the limit of our epistemic horizon.
This is a profound lesson in blind spots. We entered this session assuming we had a clear line of sight on a complex financial topic.
We were ready for it.
We thought our workspace was fully populated. And in a single sentence, the system reminded us of our own systemic vulnerability.
It really pulls the rug out from under you.
We didn't just lack the data. We were completely unaware we lacked the data until the precise moment we attempted to query it.
That is the nature of information asymmetry. The most dangerous risks in investing are not the known variables, the interest rates, the inflation prints, the stated debt maturities.
Right, those are already priced in.
The most dangerous risks are the sudden structural failures in your own information pipeline. It is the moment you reach for a crucial piece of data and grasp nothing but air.
Let me play devil's advocate again, because I want to stress test this philosophy.
Okay, bring it on.
If our environment is truly this fragile, if a single missing file or the delayed 10K can completely halt our analytical process, how does anyone ever confidently deploy capital?
That's a very fair question.
Like, if we paralyze ourselves every time a piece of data is not available in the current workspace, wouldn't we just sit in cash forever?
Yeah.
The real world is messy. Information is always somewhat incomplete.
That is the core tension of fundamental investing. You are entirely correct that information is never perfect, but there is a massive difference between incomplete data and absent primary data.
Okay, flesh that out for me.
If a 10K is missing a footnote about a minor lease obligation, that is incomplete data. You can model around that. You can apply a discount rate.
Sure, you build a margin of safety.
But if the entire income statement is missing, which is the equivalent of what we are facing here with our primary script missing, you cannot model around it. To attempt to do so is sheer hubris.
So you don't paralyze yourself. You simply recognize when the game has changed from analysis to survival.
Precisely. You do not freeze. You execute contingency protocols. Acknowledging a void does not mean you surrender. It means you shift your operational framework.
You pivot the strategy.
You say, the primary data is unavailable, therefore the primary thesis cannot be validated. I must now rely on my structural fallbacks.
Which transitions us perfectly into the second half of this remarkable, albeit frustrating, document.
The second half is where we see the system's response.
We have established a foundational absence. We have a title that promises a thesis on preferred equities, and an immediate structural admission that the thesis cannot be delivered from the original source.
The void is established.
The original generated script file, the primary asset we intended to evaluate, is definitively not available in the current workspace. So what did the system do?
It reacted.
It didn't just crash. It didn't output a blank white page. It took an action. It forced a structural reaction to the void. Let's look at the remaining portion of the text. I'll hand this over to you to read the final clause.
The remaining portion of the text reads, so this fallback file was recreated.
So this fallback file's recreated.
Yeah.
The use of the word so implies direct causality.
Yes. Cause and effect.
Because the primary asset failed, this secondary asset was deployed. But What actually is this secondary asset? I want to ask you a very direct, probing question here.
Okay.
In the context of capital allocation or even systemic architecture, what is the practical operational takeaway of a fallback file in this specific scenario?
That is the essential question of our session today. What we have to understand fundamentally is that the text we are reading right now, this single composite sentence about a missing file, is the fallback file.
It is the file.
It is a self-referential document. Its entire purpose, its absolute only function in existing, is to serve purely as a placeholder confirming its own recreation.
A placeholder, just holding space.
Yes. Think of it as a closed loop of information. A standard file, like a legitimate fundamental research report, contains external data. It points outward.
Right, it gives you insights into the real world.
Exactly. It points to facts, figures, historical precedents, and arguments about the real world, such as the mechanics of dividend yields or the subordination of preferred stock in a bankruptcy proceeding. It illuminates something beyond itself.
But this fallback file doesn't do that.
No, a fallback file, in this specific systemic manifestation, points only inward.
It's completely solipsistic.
Exactly. It says, I exist solely because the original does not exist. I am here to tell you that I am here instead of the original.
That's incredibly profound when you think about it.
It contains absolutely no external data. It contains zero data on capital allocation. It contains zero data on preferred equities. It yields no external truth.
So it is purely administrative. It is a metadata artifact.
It is an artifact of systemic resilience. We must recognize the engineering behind this.
The structural engineering.
When the overarching system queried the current workspace for the original episode 14 file and found a void, it did not fail catastrophically.
It didn't just shut down the whole program.
It did not trigger a hard stop or corrupt the broader directory. It generated a structural safety net. It recreated this fallback file so that the workspace would not be entirely empty, so that the operational cadence of the system could continue.
It kept the lights on.
But as analysts, we must be brutally clear-eyed about the nature of this safety net. It provides structural continuity, but it provides zero informational yield.
I want to translate this concept directly into portfolio management because the parallels are staggering.
You really are.
Let's say you are an institutional manager and your primary investment thesis for the year is built on a specific growth vector in emerging market technology.
Okay. High growth, high risk.
You have allocated capital based on the assumption that certain regulatory data will become available, confirming your thesis. Suddenly, the regulatory body suspends all data reporting. The data is not available in the current workspace. What is your fallback file?
Your fallback file in a portfolio context might be your cash reserves. It might be broad market index exposure or short-term U.S. Treasuries. These are assets designed to preserve the structural integrity of the portfolio when specific, granular, high-conviction data fails.
Right. Cash doesn't provide the alpha you are seeking. Cash doesn't tell you anything about emerging market tech. Cash is just a placeholder.
It just sits there.
It is a structural safety net that prevents a catastrophic loss of capital while you wait for the original data to reappear in your workspace.
Exactly. Just as this fallback file preserves the integrity of episode 14's existence within the systemic directory, even though it cannot deliver the promised content on preferred stocks.
It keeps the slot filled.
Keeps the slot filled, right? It prevents a systemic error cascade. But it is vital that the investor recognizes cash as a placeholder, not as the primary thesis.
You can't confuse the two.
If you look at this fallback file and try to extract preferred stock analysis from it, you are delusional. If you look at a portfolio holding 100% cash and claim you are aggressively capturing growth, you are equally delusional.
You have to know what you are holding. You have to understand the nature of the asset in front of you. And the asset in front of us is a notification of failure.
Let's look closely at the specific verb used at the end of the sentence. The text says, so this fallback file was recreated. It does not say it was simply created.
That prefix re is fascinating. It implies a cyclical process, doesn't it?
It implies that this is a known failure state.
Ah, like it's happened before.
The system has encountered this exact problem before, or at the very least, the architects of the system anticipated this exact vulnerability.
They built it into the code.
The system has a baked-in protocol for this precise scenario. It queries the data, it recognizes the absence of the original file, and it automatically executes a predefined routine to recreate the fallback template. It is a mechanical, dispassionate response to missing data.
Which is exactly how an elite allocator should respond to missing data in the markets. Mechanical, Dispassionate, absolutely dispassionate. You do not get angry at the missing 10K. You do not throw a tantrum because the management team delayed the earnings call.
Getting emotional destroys capital.
And most importantly, you do not let emotion drive you to intuitively guess the missing figures just so you can make a trade. You simply observe the void, recognize the failure state, and execute your contingency protocol.
You say to yourself, the specific data required to validate my thesis is not available in the current workspace. Therefore, I cannot logically deploy capital based on the original premise. I must immediately default to my structural fallbacks until the information asymmetry is resolved.
It takes an incredible amount of psychological fortitude to do that. The urge to act is so strong, especially in modern finance where we are bombarded with noise 24/7.
It is a profound test of investor discipline. I would argue it is the ultimate test.
The ultimate test, really.
Yes. The most difficult thing for an active, highly intelligent mind to do is to look directly at a void and accept it purely as a void.
Because we are pattern-seeking machines.
Exactly. The urge to act, the urge to analyze something that isn't actually there, to find a pattern in the static, is overwhelming. But true, long-term, fundamentals-minded investors know that acknowledging the strict limitations of your data set is the ultimate risk management tool.
I completely agree, and I think we need to confront the reality of our own session here.
Let's do it.
By spending this time analyzing the fallback file, are we just finding patterns in the static? Have we succumbed to the urge to act?
I would argue we have done the exact opposite. We have refused to invent the pattern.
That's true.
We have refused to discuss the mechanics of preferred stocks because the text does not permit it. Instead, we have analyzed the structure of the void itself. We are analyzing the absolute baseline truth of the document provided.
It's a very pure exercise.
It is a closed loop. The text begins by acknowledging an absence and ends by confirming the presence of a placeholder. There is no middle ground. There is no hidden thesis regarding dividends or liquidation preferences.
There is only the transparent documentation of the system's current state, which ironically makes this the purest, most undiluted form of fundamental analysis we could possibly conduct.
Pure and unyielding.
We stripped away all narrative, all macroeconomic theory, all sector bias, and we are left with nothing but the raw, unyielding mechanics of data availability.
It forces a recalibration of expectations. We entered the lab expecting a complex financial instrument to dissect.
And what did we get?
We were handed an empty box and told to analyze the craftsmanship of the cardboard.
That is a brilliant way to put it. We are analyzing the cardboard. But understanding how the box is built, understanding how the system handles the emptiness, is arguably more important than whatever was supposed to be inside.
It's foundational.
Because the contents of the box will change from day to day. One day it's preferred stocks, the next day it's convertible bonds. But the system that delivers the data, the workspace that holds the data, and the fallbacks that protect you when the data fails, those structural elements are permanent.
If your structural elements are fragile, it does not matter how brilliant your analysis of preferred stocks might be.
It won't save you.
If you cannot correctly identify and handle a missing file, you cannot safely allocate capital.
Exactly. Let's talk about the danger of false confidence. Let's imagine a scenario where the system didn't give us this honest fallback file.
Okay, a hypothetical glitch.
Imagine if the system had glitched in a different way. Imagine if the original script file for episode 14 on preferred stocks was missing, but instead of telling us it was missing, the system just pulled up the script from episode 13 on, say, municipal bonds and slapped the episode 14 title on it.
That would be a catastrophic data integrity failure.
It would be deadly. If we weren't paying absolute rigorous attention, we might start analyzing municipal bonds while thinking we were analyzing preferred stocks.
Which is terrifying.
We would be deploying capital into the wrong asset class because the labeling was corrupt, but the system presented it as valid.
That happens in the markets constantly. It is called mispriced risk.
Mispriced risk.
Investors look at a security, they assume they are looking at a safe, yield-generating asset because of the label or the historical reputation of the issuer. But the underlying data, the actual mechanics operating in the current workspace, has fundamentally shifted.
So they are blind.
They are analyzing the wrong file, but because the system didn't explicitly flag an error, they proceed with false confidence.
That makes me appreciate this fallback file so much more. This simple sentence: The original generated script file is not available in the current workspace, so this fallback file was recreated. It's actually an act of incredible systemic integrity.
It really is an honest system.
It is brutally honest. It
Mm.
does not try to fake the data. It does not pull the wrong file. It raises a red flag immediately and says, stop, the thesis is broken. Here's your placeholder.
Honesty in data architecture is just as critical as honesty in management teams.
I completely agree.
When a CEO comes out and says, we have no visibility into the next quarter, we are pulling our guidance, the market hates it, the stock drops, but from an analytical standpoint, that CEO has just done you a massive favor.
By defining the void.
They have explicitly defined the void. They have given you the fallback file.
It's the management teams that try to paper over the void, that try to invent the data to meet expectations that eventually cause the massive blowups.
Yes, the fakers.
Enron was essentially a company that refused to generate a fallback file. They just kept inventing original script files out of thin air until the entire workspace collapsed.
A very apt comparison. The refusal to acknowledge the absence of genuine value leads directly to fraud. In our case today, the system functioned perfectly, ethically, and transparently. It lacked the value, and it reported the lack of value.
So, to summarize our findings from this incredibly sparse document, we have learned 3 fundamental truths.
Let's hear them.
First, that expected data can and will suddenly become unavailable in your active workspace. Second, that attempting to interpolate or guess the contents of that missing data is a violation of fundamental discipline.
A severe violation.
And third, that a robust system, whether it is a digital architecture or a human investor's risk management framework, must automatically generate a fallback placeholder to prevent catastrophic failure while providing 0 false signals about the missing data.
That is a precise and exhaustive synthesis of the text provided.
As we draw this rigorous and admittedly unconventional deep dive to a close, I want to pivot and leave you, the listener, with a final thought to mull over.
A final takeaway.
We have spent this entire session deeply analyzing the metadata of a missing script. And what this ultimately highlights, beyond the mechanics of our specific system, is the profound fragility of digital workspaces and informational environments.
We build these incredible complex intellectual frameworks. We design highly automated systems to generate, scrape, and store financial data. But at the end of the day, a single missing file, a minor server disconnect, can completely halt the analytical process.
Sometimes in deep fundamental research, and absolutely in the high-stakes world of capital allocation, the most glaring, the most critical piece of data you must confront is the complete and utter absence of the data you are expecting.
It's always what you don't see.
It isn't the declining margin that kills you, it's the margin you couldn't see. How you react to that sudden absence, whether you aggressively invent a narrative to fill it or whether you patiently execute your contingency protocols, ultimately defines your discipline and your survival as an investor.
A vital lesson in epistemic humility and structural adherence.
Thanks for joining.
It was a pleasure.
If you found this useful, like the episode and subscribe. It really helps us keep these lessons free.